Hello, everyone. Welcome to the stock-specific class here for Thursday, June the 15th. If you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. Or if there's any audio issues that you're noticing on your end, make sure you let me know as well. We haven't had them for a while, but if you do notice something, let me know so sometimes I can dial back in and get rid of it. Just a quick reminder that the markets will be closed on Monday for the Juneteenth holiday, which is a newer holiday. I think it's just been the last couple of years or so the market's been closed on it. And it's getting to a point now where we've got a market holiday almost every month, which is not too bad. I mean, I kind of like some of those holidays because, aside from the weekend, sometimes you need that extra day just to be out of the markets, not have to worry about your positions or anything like that. So I'm all for that. Plus, it allows you to be flexible, setting up your vacations throughout the year where you can squeeze in that extra day, make it a 3-day weekend. Although I guess this one could end up because it just happens to be on Monday. I think that one can end up any time during the week because I think it's always on the 19th. If I'm not mistaken. But anyway, just make a note of that. It won't affect us because our next market update class is on Tuesday. All right. So yesterday we had the Fed news. We've had all the big news this week for the market to digest, so to speak. There really isn't any major, at least that I can see. Again, the market can suddenly fixate on something else right away, but I would assume the next big area that it'll focus on would be the jobs report in July. What happens there might affect whether the Fed continues to hike. They said they're going to hike 2 more times or could hike 2 more times. Right now, the market doesn't seem to believe that, which is why I think it's charging forward today. But again, I still get back to, that whole argument that I've made about understanding human nature, that if the economy cranks back up right here, inflation is going to go right back up again. There hasn't been enough pain in the spending, people being afraid to spend, and it would crank right back up. I think the Fed knows that. That's why they're keeping more of a hawkish tone. And I guess the way you could avoid, what they're obviously they're trying to orchestrate a soft landing. How would that be? Well, maybe if things slow down but you're not in recession, but you're kind of slowed things down and it's that way for longer, meaning that the rates remain high for a while. Could that slow down some of those spending habits? That's probably what they're hoping for. That it's a little bit more gradual. Knowing that, again, knowing human nature, I just don't think we don't do anything gradually. It's either all forward or we completely stop. We either spend, or we totally stop spending. And that seems to be the history. But again, we're going to follow the trend and whatever the market seems to do. We are getting a little bit stretched in the market, and that's something to keep an eye on. There's a couple key points that I'll show you today. And it doesn't mean that I don't want to, that I won't jump into anything. In fact, there's a pattern I might get into today, add to the portfolio. I told you I'll start to add, especially if we break out above this range. You have to recognize what the market is actually doing, even if you don't trust it. You can't get dug into a bias to where you ignore what price is actually doing, what the trend is actually doing. And it has maintained a clear breakout of that resistance that we'll take a look at here in just a second. but we're also getting a little stretched. And that's my biggest point is the ideal point to enter in is to look for the next consolidation, whether it's a pullback or just moving sideways a little bit to consolidate the recent move, alleviate a little bit of that overbought condition. And that's where you'd want to be probably a little bit more aggressive. So we're getting closer to start add more or be more aggressive in the portfolio. But if we look at the direction alerts, momentum is getting higher. And again, this is not factoring in today's push, which is a pretty significant push. We're getting about a 1% move. Excuse me. Which will probably push us a little bit further to the right side of that extreme reversal risk box when it updates overnight. The breadth indicator is still lagging though, and I've heard a lot of people talking about how it's not just those big cap tech stocks anymore that are leading the market higher, and that's true to an extent. But what's actually happening is there's been a little bit of a pause in those big cap tech stocks, but it's been more of a rotation. Money is coming out of the big cap tech and it's going into some other areas. It's going into some of these speculative smaller cap companies. Some of the heavily shorted companies, we've seen them pop quite a bit over the last little bit. Beyond Meat had a big spike up from almost going out of business. I think down below a couple dollars a share or something. It's had a little bit of a spike, but it's still not concentrated. There's still not a lot of stocks participating. It's just moved. It's moved into, in this case, it's moved into more speculative areas, which is really kind of odd. Especially when we're still at the very least, we're in a pause with interest rates going higher, but they're not. I don't think we're anywhere close to having them go down. And usually when you see speculative stocks really start taking off, it's when interest rates are coming down. When we had COVID, remember, interest rates got dropped right to 0%, and immediately these speculative stocks, these SPACs, all these things started to really take off because, again, they can borrow money for nothing, and that's what those startup companies are relying on, is that cheap money to kind of get started, and that's why they really started to crash as soon as the rate cycle started to move higher, or the Fed started to raise rates. All those stocks got crushed. So it doesn't make sense to see them rallying. I mean, I can see it just strictly from a short squeeze standpoint. But it's also a reflection that there's probably a little bit of retail investors jumping in, and they're remembering 2020, and they're jumping right back into those same stocks that were $10 stocks during 2020, and now they're $1 stocks, and they're thinking, boy, if they just go back to $10 again, it'll be, they'll relive those casino days that were that second half of 2020 when the market just went straight up. So it's odd, especially with everything you kind of see ahead of us. But again, I gave up a long time ago trying to expect the market to make sense. In fact, just the opposite. I just assume it's not going to make sense or interpret the world the way I see it, what I see happening. And so that's why, again, if you want to save a lot of time in your life, or really narrow your focus with all the distractions you can get into with trading, focus just on reading charts and price action, and put all your time into that, and you'll be just fine. So breadth is lagging, and it's continuing to lag. Again, the argument you can make is it going to catch up? Well, the best way to kind of see that is going to be the behavior of the Russell 2000. If the Russell 2000 starts to really take off, it did start to take off last week, but it stalled at this resistance area that I'll point out here in just a second. if it can re-engage, and it's lagging today again quite a bit, but if it can re-engage, and that's a good sign of seeing a lot of participation in the market. That's usually one of my first indications of market breadth is looking at that Russell 2000, because it incorporates much broader. It's 2,000 stocks as opposed to 500, and you're going to get a little bit. You'll be able to see that broader participation or non-participation, and it's visual. It's real quick to notice. But yeah, that's still a concern. And again, sentiment's going to remain pretty high for a long time unless we get a massive market crash. Other things to keep an eye on: buy-sell ratios are still not extreme. The buys have outpaced the sells, which you would expect with the recent rally, but we're not stretched too far yet. However, some of the sentiment indicators are bumping up. We're back up against that. And again, this will update overnight, which will probably push us above this red line. Again, it doesn't mean that the market's going to drop dramatically out of this. Even the last few times that we pushed above it or to it, they were modest pullbacks that the market made. 2 or 3 day drop or something like that. So I'm not suggesting that this is saying, oh man, all hell's going to break loose. But just keep in mind that it's a dangerous area to start buying into when it gets this stretched. And that's all I've been pointing out over the last week is, we're in a position where we're probably going to get a little bit of a pullback here soon. And that's when you want to evaluate. And actually that's how you want to see how the market pulls back. When you're in the uptrend, you've been stair stepping up and you're in this impulsive move. Well, first of all, usually when you can recognize you're in an impulsive move, it could be that you're nearing the end of it, at least temporarily. You're about to go into another correction, and you want to see how you correct. Again, if you're pulling back and you're more choppy and kind of that ABC look, that's a signal that the uptrend is probably going to continue. It's acting like a pullback within the uptrend. If you get a sharp sell-off that looks like an impulsive move down and then you try to rally and it's sluggish, that's a warning sign. A good example of this, and one that I'm kind of watching, especially on a day like today, when the market is up significantly, particularly the NASDAQ, but you look at Google and you had this run up, you had a corrective move right here, and then you had impulsive up and then impulsive down. And now the market's been rallying and it's sluggish. It can't seem to rally right there. That looks like a corrective move of this smaller impulsive move down. And it looks to me like Google's getting ready to have either a wave C, which would be the bullish, longer term bullish outlook, where it just has one more move down and then it holds this trend line right here and then takes off again. Or it's starting something bigger where this is just the start, wave 1, wave 2, wave 3, wave 4, wave 5. Either way, there's a high probability that at some point, probably within the next few days, you get another move down based off of that behavior. Now, this behavior is not perfect. I've seen, especially recently, with as strong as this recent rally has been, where charts have looked like they're rolling over like this, and then suddenly you get a real big bullish day, and it just flip-flops right back to the other side there. And that's why none of this stuff is perfect. But the key is recognizing the behavior, because all we're looking for is what is going to happen the majority of the time. Most of the time, when you see this type of behavior, it's going to lead to at least another move down. And so, believe me, if it always did, this is the only pattern I'd look for, and I'd be a gazillionaire, because it would always work. It'll throw you off sometimes, and this is a perfect environment for it to throw you off, because we're getting into kind of a mania type of market condition where people are buying, and they're just buying just because everyone's buying and everyone's telling them they should buy, not because they're looking at fundamentals or looking at charts or anything like that. And so you're getting some of these irrational moves. And so if there's an environment where this type of chart behavior would, you have more instances of failing, the pattern failing or the behavior failing, that's kind of what we're in right now. But see that, so here's the dilemma though. The dilemma is then, okay, let's pull up the SPY chart here. So the market is shaking off some of these bearish reversals. In fact, yesterday we had we were starting to form a bearish candle right after the announcement came out. We were right up here, and then we sold off all the way down into here. And that was a red candle right there. And then the news conference came on, and whatever Powell said during the news conference caused the market to come off the lows. Now it didn't show a bullish. That's an indecision candle. So if I'm looking at this saying, was there anything yesterday that predicted today's rally? No. It was saying that at the end of the day there was a tug of war between the buyers and sellers, and it was equal at the end of the day. Nobody won, and there was no indication of whether the trend would continue. In fact, I'm looking at this just the opposite, saying with this big of a run up, and now you're starting to get an indecision candle right up here. There was probably, if I were to rate this from a probability standpoint, understanding price action, I would say there was a higher probability of it dropping out of that candle. At least today, a short-term move would have been down today. Well, it didn't. It made the lower probability move where it got stretched even higher. So the danger in these situations is I've been through a lot of manias where they can keep up for a while. And in fact, I keep referencing back to when I first started trading. The first big bubble that I dealt with was the internet bubble of 2000. From October of 1999 through April of 2000, we had this mania run where things just kept going higher and higher. Didn't make any sense, and but it just kept charging, and valuations were just crazy. It was just unbelievable that some of these companies just kept going higher. So I've seen it with my own eyes. I experienced it. Now the problem was I didn't know how to read charts very well back then, and I chased it, and I made a lot of money very quickly chasing the mania. But I also wiped out my account when it reversed because I didn't understand how to recognize that was abnormal, and how quickly things can drop when that bubble bursts or when the mania ends, how fast it can reverse, and how to recognize the signals ahead of time, the price action ahead of time, the behavior ahead of time. It blew out of an account. I had to start all over again. So, but that's the danger here is you either can chase an overbought market, and if you're right, it feels good. You feel like you didn't miss it. But if you're wrong, or if you're right temporarily and then you get slammed back down and you're wrong in a big way, like I said, it could cause real damage. And like I said, it could wipe out a year or two worth of gains in 1 month or a few weeks. So, but one of the weird things I've recognized of human nature is there, and this is weird. You're not going to believe me, but it's true. I don't know why it's true, but the people will be more upset with a missed gain than they will with a loss. In other words, and I've dealt with this myself. I've learned to kind of deal with it where it's not. I don't have this emotion as strong as because I understand now. It's one of those things that you kind of recognize that trait, and then when you understand it, you're less likely to be caught up in it. But for instance, if you bought a $20 stock and it went to $30 and you had a $10 gain and you got out. And that stock, as soon as you got out, that stock went to $60, meaning you missed out on another $30 profit. That you will actually get more upset that you missed that $30 profit than if you would have bought that stock and it would have gone down to $15 and you lost $5. I don't understand this. I don't understand why that is. But I've not only dealt with it personally, but I'm an instructor. So I've dealt with thousands of students I've taught over a 20-plus year period. And it's a fascinating dynamic that they get more upset when they missed out on an additional gain. They made $10, but because they missed out on that extra $30, they're more upset than if they would have had a $5 loss. So that's the dilemma here, and that's what drives some of these manias and these irrational moves is that people are so afraid of getting out too soon, missing it, having it go up even higher, or that they got out because the market stretched. I got out right here and it went up again. I'm like, oh crap, why didn't I just stay in this thing? They're more upset today that they got out here than if it would have pulled back and they would have lost a little bit of money. And so when you understand that, some of the stuff makes a little bit more sense. It makes sense why people will chase moves or stay in moves longer than they should. And so that's always been the dilemma, because when I'm teaching these classes, I'll say, boy, you don't want to chase this, and you want to wait for that pullback, and we may not get the pullback for another 2 weeks or something like that. It may keep going higher, and then I get people that send me angry emails that say, well, Jerry, I would have gotten in this thing, but you were so bearish that I didn't get in, and now look at it, we're up another 5 or 6%. I will get angry emails when I'm telling people this is an area where you don't want to chase the move, or you don't want to be too aggressive. I'm not saying you can't have some trades in the game. You just don't want to get aggressive right here at this stage. You'd want to see how it pulls back, and then if you got a corrective pullback where it's more choppy, that's where you want to get aggressive and trade that next move higher. Now, there's also a dynamic here psychologically. It's something I teach all the time, that you have to develop a bus stop mentality when you're trading. What do I mean by that? Well, what happens at a bus stop? If you miss the bus, what happens? You sit down on the bench. Not like I've ridden a bus last time I rode a bus, I was probably 12 years old, and I couldn't drive and didn't have friends old enough to drive. But what happens? Well, I shouldn't say that. I've been on buses at the airport, so we'll use the airport mentality. You miss the bus. What happens? You wait there at the bench, and what happens? Another bus comes by in 10 or 15, 20 minutes, and you get on that bus, and you're fine. Well, you have to have that mentality in the markets where, okay, if you miss a move, if we miss this rally, who cares? There'll be another rally. There'll be another entry point. If you get too upset with missing a move, then what happens is you tend to do irrational things where you're running down the road, chasing after the bus, jumping on the back of the bus, which would be very dangerous to do, right? Doing something idiotic because you don't understand that another bus is going to come around. You start chasing a move, and you get in. Probably the time you get in is right when it has a sharp sell-off or a big sell-off, and then you really think that you've got bad luck. Well, you don't have bad luck. You had a bad entry. You weren't patient enough there. So anyway, just wanted to point that out, because I see this happen. This cycle is nothing new. These things are things that you just deal with over and over again over a 20-year period, and but it's amazing how many people get caught up in the same way, and they have the same results a lot of times because they're not patient enough. All right, so let's go back and look at a longer term chart so we can see the breakout area. Now, yesterday was interesting because we had broken out the day before, and then we were having that indecision candle there. So, it's looking like maybe, is it going to pull back right after that breakout? Today is solidly moved higher. This is going to be the next target that most people are going to be focused on, kind of this 460 area up here. Now, I pointed this out on Tuesday that would it be possible, I was expecting maybe a mid, here was that last resistance area right here. I thought maybe there could be a mid reversal or pullback in the middle somewhere where no one's expecting it. Can the same thing happen here? It's kind of somewhere in this middle part. That's possible, and it's really possible when you look at the QQQ chart. Because it is just below its next major resistance area right here. And the Qs are much more stretched than all the other indexes. You see it's gone almost parabolic right here. Now, could it break through that? It can always just blow through resistance areas. But you figure you're already stretched, you're already overbought, and then you're hitting a resistance area. And you can let's see if we can see it. Well, it's right. I can point out right here. It is about 371. So we're only about three points away from that hitting that resistance area there. Now you also have the Dow it's in a resistance area too right now. It's trying to break above that today. It's not as defined. It went a little bit above it here. It's a little bit below it here. I mean, this is more of a resistance range or area. Now, this is also a key area for the Dow. We pointed this out that this could be an inverse head and shoulders pattern. There's your neckline. You break up significantly above that. That could be pretty bullish. And I still would recognize that. But again, we probably need to see a little bit of a consolidation. It could move sideways. Again, the market doesn't have to pull back to alleviate an overbought condition. It can start to just kind of move a little bit sideways or something like that. Hopefully it doesn't move too sideways, because I like to trade options, and sideways movements for option trades are terrible. And then look at the Russell 2000, and this is where we look at the market breadth. And you can see it's lagging, and it's also bumping up against the support resistance area. Support back here, resistance in this area here and here and here and here. Support right in here, a little bit of resistance there as it dropped, and then bumping up against there. And if we zoom in, you can see that, especially yesterday, it dropped. Today it's fighting to go higher, but it's basically flatlined today. It's 0.06%, and you compare that to almost a 1% move in the Qs. We are a 1% move in the Dow, and almost a 1% move in the SPY. So again, what's lagging? You've got 30 Dow stocks of the largest companies representing different sectors, right? 1% move up. You've got the S&P 500. You got 500 stocks up almost 1%. You've got the NASDAQ 100 stocks. NASDAQ 100 is almost pretty much all those stocks are part of the S&P 500. Okay. And then you got the Russell 2000 that's up there, basically break even. So what is that showing you? It's showing you a concentration. There's a concentration, not just now. This concentration isn't just showing the 7 or 8 mega cap tech stocks, okay, but it's still concentrated in a fewer number of stocks, okay. And this is why we like to see the Russell leading, because when it's leading, it's telling you that there's a lot of stocks that are participating. Again, we're not suggesting that little tiny 1,000 in the Russell 2000 stock is going to determine where the market goes. Okay, when we say that Russell 2000 is a leading indicator, we're not suggesting that your hometown bank, that's small bank, but it's still part of the Russell 2000, is going to lead us out of a downtrend or out of a bear market. What it tells you, though, is participation. That a lot of stocks are part of the move and they're driving the move, and that's always healthy when you see that. And it's usually unhealthy when you're not seeing it. So that's why we focus on it, look at it. It's not going to tell you something every day, and just because it's lagging a little bit today doesn't mean that it can't change and break out. And it did outperform the other indexes right in through here on this little move right through here. We had big 2% moves in the Russell 2000. We were having 1% moves in the S&P. But that's something to keep an eye on. It's right at that resistance area. And does that resistance area hold? And again, you go back to these other, the Dow's getting into that extreme reversal risk range, and it could go. It's not the far right side, so could it go a little bit further? Absolutely, we're recognizing that. All right, I don't want to spend too much time on. I went through most season during the market update on Tuesday, and really a lot of the ones down here haven't changed. The bond market did jump a little bit today with that Fed news. We'll see if that continues, but it's still stuck in more of a sideways range. It's been moving more sideways. And so until it kind of breaks into a more of a trend direction, then I'm not going to pay too much attention to it. Gold's been moving sideways. Oil's been moving sideways. We got to see a little bit more of a direction there. The dollar had a significant move down today, and it's moved down kind of below that 618 retracement level. And the reason why that's significant is I was looking at this as more of an ABC pattern setting up for another rally in the dollar. And with that, and this is the UUP, which is the ETF. But if you want to get a better chart of the dollar, I like to use the dollar index. Now this isn't I can't pull this up on TradersPro. There's certain things that you can't pull up on TradersPro. If it's an ETF, you can, and that's why we kind of use these ETFs to look at some of these, to look at gold, to look at oil and things like that. You can see that dramatic drop. And if I use my retracement tool here, you can see now we're clearly below that 618 retracement level. Now, what does that mean? Well, much the reason why we're turning a little bit more bullish on the market, because it's moved above the 618 retracement of that big drop to March, to the October lows last year. The dollar now below that 618 retracement, it makes it more likely we're going to work our way towards this previous low right here, maybe even lower, as opposed to this being a pullback within the uptrend. Now, you can have deep pullbacks. I'm not saying it can't be a deep pullback and still rally. It's just that this is when it dips below that 618 retracement, the probabilities start to shift. Not shift dramatically, they just start to shift, and so you have to kind of shift with it. Now, if suddenly over the next few days it shot up in a strong way, looked impulsive as it's moving up. By the way, that looks impulsive down too, so that's adding to more of the bearishness on the dollar there too. But if it suddenly shot up in an impulsive way, well, now you got impulsive down, impulsive up. and it could have just been a deep retracement, and now it's back to acting like an uptrend again. You can see how that next correction looks. It looked more choppy, more sideways. That would make it more likely to continue to move higher and all that kind of stuff. So, so we'll keep an eye on that. But today's move was significant on the dollar. The VIX, I'm sure just stayed right there for the VIX. Now, what do I always tell you about the VIX? A lot of times it's not telling us anything. And if we're thinking it tells us something every day, you're probably overanalyzing it. But we really want to pay attention when you see the VIX and the market, the S&P specifically, that's important. But when you see the S&P and the VIX moving in the same direction, pay attention. Well, what do we have today? We've got the S&P up 1%, and we have the VIX up 2%. Now, it's not a huge move on the VIX, but the VIX is up and the market is up. Now, what does that mean? Well, we saw that happen back here on Monday. And if you remember on Tuesday's class, I said I thought that you know, you do want to pay attention, but I thought that move up with the market moving up was probably more tied to the anticipation of those big news events, the CPI report on Tuesday, the Fed meeting on Wednesday, and that people might have wanted to hedge a little bit ahead of that just in case the market sold off on that news. But now all that's behind us. And so a move like this today, to me, is telling me that professional traders are noticing that the market is getting a little bit stretched to the upside. It's going up a little bit too far, too fast. They're not rushing in to buy protective puts, but they're buying stocks still, but they're also buying some protective puts along with the stocks. And because they've had some good gains over, remember Tuesday I was talking about, or it might have been last week, I was talking about how those big professional traders haven't been hedging because not only do they haven't needed it, they've been wasting money early on hedging and buying protection when they haven't needed it, but also we were moving sideways, so their profits weren't big enough to justify buying that protection either. You know, if you're making $100 and you're spending $5 on protective puts, it's no big deal. You're like, okay, that's worth it to have that protection. I'll get my $100 gain. I'll spin off $5 of it so that I don't have a disaster happen. You can justify that pretty easily. If you're making a $10 profit and you're spending $5 in protective puts, that's half your profits there. You're saying, well, wait a second here. Not only do I not want to spend this money, I haven't needed it to spend this money. And so that behavior is what has really depressed the VIX. It's caused the VIX to come way, way down to these low levels. Now, again, you think about that for a second. What's the danger then? Well, the danger is that if anything dramatic happened and the market sold off, you've got all these big fund managers that aren't hedged. They're going to be forced to sell, and they're going to be forced to buy protective puts and they're just going to get hammered. And they're really going to panic to buy those protective puts because they need them right now. You know, the flood is coming. The wall of water is heading towards their house. And they're on the phone with their insurance guy trying to buy flood insurance as fast as they can. Giving out their credit card number and not caring who hears it because they want the insurance before the flood hits, you know. But now they've had this run up. We've had this run up now where if you look at let's look at the SPY, you can see it. So right in here, they weren't making enough money to justify those protective puts. But now, especially on a day like today, biggest candle we've had in a while, they're feeling, okay, maybe we should take some of that and buy a little protection. We're getting stretched, but now I can afford to buy it, or I can justify buying it. And they're not buying it aggressively, okay, but they're starting to, hedge a little bit. And now I wouldn't quite say, a lot of times when I see this, when I see the market up and the VIX up, my first reaction is it's the professionals tell you they don't trust the rally, okay, and so they're believing that it could pull back at any moment, and it's a little bit of a signal of that. But I think it's not as dramatic in this case. I think it's just them now they're able to justify buying a little of that protection. It's a smart thing to do. Now you're back up. Maybe maybe not making $100 profit and spending $5 for protected puts. Maybe it's just a $50 profit. But now you can justify, and maybe not buying $5 of protected puts, but $2 of protected puts. You can justify that. So I think that's a little bit of what's going on there. But it's something to keep an eye on. If you see that you're having some of these up days and the VIX is starting to move up more dramatically or noticeably, then it could be a signal that those professional traders are expecting a pullback pretty soon. This is usually what you look for in a raging long-term bull market is that you'll start to see the VIX start ticking up when that market gets stretched. We're still not in we're not in that condition, which is why it's just amazed me that the VIX is down this low. But there again, another thing the market has done to make me made me realize that crazy things can happen, and who knows? The reason why I'm waiting on this is because at any moment we could have some massive event and the market could drop dramatically, and then, like I said, you wake up and the Dow's down 1,000 points, 2,000 points, and you can look back and say, well, the VIX has been signaling this for months, but it's also a reason that you wouldn't want to base your entire trading decision on that analysis alone. And I'm always clear to point that out. It's not an immediate indicator. Sometimes it can be pretty immediate. It has predicted some of the bigger market sell-offs over the years that I've seen, and within a few days or even a week or so, been pretty close. So I still trust it and use it. But like I said, obviously, there's nothing that I go through in this class that's everything is reliant on that particular indicator. I look at a number of clues. I teach that. I think it's important that you look at what. Now you don't want to overanalyze. You could have too many things you're looking at. You got some that are saying it could go up, some that are saying it could go down, and then you get really, really confused or scared to do anything. But the opposite is dangerous too, where you're basing your entire investment or trading decision on one thing, and especially one thing that can't be perfect every time, because the markets aren't perfect every time, and you get beat up pretty well. All right, so that's something interesting to watch, and boy, notice too, the market keeps going higher. It's been going higher even while we've been talking. When I started class, the SPY was right about in here. It was above that red resistance line, and now it's up here. So it just continues to climb. But so now the VIX is climbing as well. In fact, you can see it if we drop down to an hourly chart here. You can see just in the last hour it's been moving up. Well, guess what? So is here's the last 2 hours of the SPY. See, it's been moving up pretty dramatically the last couple hours there. So, that doesn't mean that a pullback is happening tomorrow. I don't see any sign of that. Okay, right, at least as of today with today's move. I could have made that argument yesterday with that indecision candle at that resistance area there, but it is getting to an area where it'd be dangerous to get too aggressive right there, to jump in and be too aggressive. Chip stocks are lagging a little bit today. They're down 0.5%. Again, all that's showing is a little bit of buying exhaustion. It had a pretty big move yesterday when the market was a little bit more indecisive. So again, probably just a little bit of profit taking or taking some money out of chip stocks and maybe putting into another area or something like that. Transportation stocks have really taken off. But even then, they're at the far right side of that extreme reversal risk. And but they've been outperforming the Dow, which is usually what they tend to be a leadership of the Dow. Dow's up pretty strong today too, but that's something to keep an eye on. That'd be a pretty bullish argument there that the transports are behaving really strong. All right, so let's look at some stocks. Let's go into I usually like to just throw in a few of the new buy stocks. This top one right here, 99 strength rate, AMAM biotech stock. You've got again, you could wait for a breakout here as a little bit of additional confirmation. But you got a nice little triangle formation that's forming right here. We call that an ascending triangle, and usually it's going to break to the upside, and it's definitely bullish if it breaks the upside. If it breaks to the downside, that'd be bearish. So there again, you could wait for the breakout, or you could just manage it where you're anticipating it's going to break out. Maybe put a stop down below here or below that previous breakout area, resistance area. Now remember, these biotech stocks, we benefited from one of them earlier this week where it got taken over by Novartis and it gapped way up and we made $5,000 overnight. Well, at least on that overnight move that took place. But they can come down just as quick too. So you don't have too many of these in your portfolio because it could be a disaster if it doesn't work. Another one, this INSP, Inspire Medical Systems, 93 strength rank. Kind of a similar formation here. Hold on just a second. Give me a second here. Sorry. Sorry, apologize for that. Okay, so this stock, kind of a similar pattern. Again, bumping up against resistance. There's your support. There's your triangle. You could wait for it to break out or anticipate it's going to break out. Maybe put a stop down below here or even below here or something like that. Another one is Snowflake. I like this pattern here. 91 strength rank. Kind of a big move the last couple of days, but I like if you back out a little bit and look at a little bit of a longer term chart. I mean, this is something I just love to see, that kind of that bowl shaped move. You had a higher high right here, so you reverse the lower highs and lower lows down through here. Higher high, higher low, higher high, higher low, higher high. It's acting like an uptrend. I can put a stop down below here. It should, at the very least, work its way back up to that previous high. And it is this could be, and this is why you don't always have to wait for the market to pull back too. It can depend on how you're going to manage your trade. If you put a stop down, well, this might be a little bit of a tight stop though. I mean, if the market does correct and could this come all the way down and stop you out and then take off again? Yeah, it could do that. But if you're okay with the risk amount and you're okay that maybe you're getting in right when it pulls back a little bit, but maybe it holds that area there and still continues to move higher. Or again, this market could just, like I said, back in 2000, it just kept going higher every day. It didn't make any sense, but it'd go higher almost every day. And every day you're like, man, this is getting even more overbought. This is even more overbought. This is crazy. So, but the key is that you wouldn't want to have too many of these where you're chasing the move a little bit. You might have one or two. You wouldn't want to you don't want to load up your account right now in case that happens. And what we can do too with these is, remember, if it does look like it's about ready to pull back, we'll jump in and we'll buy some of those inverse ETFs and hedge with those a little bit. What's nice is that big move we got, that $5,000 we got in the portfolio, allows us to be able to jump into a few trades here and not worry that if they don't work out. Not that I just want to waste money or anything, but let me go to go to the portfolio here. Let's pause. Okay, here we go. So we've got a lot of cash still available. We're up. Remember, we were right at that 137 area. We're up around 142. If we had $1,000 risk in a trade, wouldn't be that big of a deal. Well, I'm going to add, I like this snowflake pattern. So I'm going to add this one. And I'm going to put that stop right down here at about 166. So it's a pretty tight stop. And so let's add this in. 166 stop, and probably about 40 or 50 shares. Let's do 40. 40 shares would be 7,500. How much at risk? So if we got stopped out, we'd lose $900. That's fine with me. I'm willing to risk 1,000. See if this thing could go higher. If the market kind of still wants to take off and go. And if it shows a really strong reversal in the next day or two, I'll hedge it with the ARKK or the SOXS inverse ETF, and so we could offset any losses if it pulls back. All right, let's get into some sectors here. Aerospace. Let's start with construction. I liked this Eagle Materials, 85 strength rank. We're a little bit below 90, but I will tell you it's hard to get a strength rank above 90 in the construction sector. There's some sectors where you have to kind of widen the range a little bit, like computer technology, biotech, some of the larger sectors. You're going to have a ton of stocks in that 90 to 99 strength rank, 90 to 100 strength rank range. There are some sectors though where you can see here there's only three three stocks that are in the 90s and they're mid to low 90s. So usually I can dip down a little bit, still be okay in sectors like construction. Sometimes some of the aerospace ones are like that as well. But I like this EXP. And you could wait for the breakout. Sometimes these sideways moves can last a while, and you could ask, why hasn't it broken out with the way the market's breaking out lately? But it already had a big move ahead of that when the market was dropping or moving sideways. So it could just be a consolidation with an expected move higher. So, but like I said, you could wait for a break out of that sideways range. Well, it makes sense that it's moving a little bit sideways too. You're right at the top of so that'd be a significant breakout. That'd be, you're almost kind of forming that cup with handle formation. But I like it when it gets up to a major breakout area, then consolidates and then breaks out. I can usually trust that breakout move a lot more. That's a pretty good long-term chart too. All right, now let's look at aerospace. I like this. That pulls up here. HXL 84 strength rank. Again, it's kind of bumping into that resistance, but you're getting the higher lows. And you could wait, see if this one breaks out as well and buy the breakout. But I like that pattern. You can see that it's held this trend line pretty well. So you could put a stop down below here, a little bit of a wide stop, expecting that it's going to break out. It's getting to the corner of the triangle, so it should be breaking out pretty soon if it's going to break out. The computer and technology, I like Rambus here, 98 strength rank. Now, this probably needs a little bit of confirmation but it looks like a possible bullish ABC pattern that's completing. You get a little bit of an indecision candle right here. Wouldn't be a bad idea. Now, what are some things you could use as confirmation? Well, one, you could wait for it to go back to a buy signal instead of hold signal right now. That means you're probably looking at getting back up into this area right here to go back to a buy signal. Or one of the ones I like to use is just a close above the high of the previous day. So all during this drop, you never closed above the high of the previous day. And one signal that you might be done going down. Now, context is important for this. You don't want to make that your primary entry technique just on its own. But what would tell me that downward move is done or could be done? Well, it's the first time you close above the high of the previous day could tell you that maybe that's done. And in the context of maybe this being an ABC pattern, and you're getting a close above the high of the previous day, that might give you a stronger confirmation that you're starting to move up again, or could start to move up again. Now, remember, it's not a trade above the high of the previous day, or it's not a close above the close of the previous day. It's a close above the high of the previous day. And so we're not going to get that today because yesterday's high was right here. So tomorrow you'd look to see if it closes above that high tomorrow. If it doesn't, it's still going down. Then you'd look at the high of that day on Tuesday when the market opens, see if it closes above that. And if it gets too much further down here, now your wave C is much longer than wave A, and it might not be an ABC pattern. You might be dealing with a trend reversal at that point. All right, another one. This IONQ 97 strength rank. Again, just a nice corrective pattern. So this is what I'm talking about, how you want to see how the stock corrects. You have this big run up right here. So I want to chase it on this day right here. Well, you could, but then what happened? It just, now you got in, it's going to move sideways here for the next 2 weeks. You could add your money somewhere else for that whole month. Okay. But I want to see how it pulls back. It started to pull back a little bit, and then it rallied back up. Look, it's more choppy, more sideways. That's telling you there's a higher probability this thing is not done going up. There's a higher probability it's going to continue to go higher. Doesn't mean it will. We're talking probabilities, not absolutes. But it's acting like it wants to still go higher. Now, if it would have shot right down like this and then tried to rally in more of a choppy fashion, I would have said that looks like a trend reversal. It probably has lower to go. And that's what I'm saying we need to probably do in this market environment here is see how we pull back to determine whether we want to buy into this recent uptrend or not. Another one here. This NTNX 96 strength rank, kind of the same thing. It's been consolidating right here. You got this kind of the couplet handle type formation. And then let's do one more under business services. I like the CPRT 91 strength rank. Again, kind of the same thing, kind of been consolidating a little bit. Nice long uptrend there. All right. Portfolio again, real quickly. Gold again, I'm near my stop, but it's still just moving sideways. I'm kind of letting that one just kind of go until either it gets stopped out or it holds and it goes back up again. That'd be fine with me too if it does that. ADMA looks like it's kind of looks like an ABC pattern right here. So this one still looks good. My stop is, I think, is down around here, so it's pretty close to my stop. But so far, it's been holding up. We'll see if that continues. SGML worried me a little bit yesterday, but my stop's down below here, so it's still fine. It dropped, and then now it's kind of working its way back up. I think it had its earnings, or it's going to have its earnings here pretty soon. And then Snowflake we just added. All right, we'll see how things go. Again, if you joined late, just a quick reminder that Monday is a market holiday for Juneteenth. And then, but it won't really affect us as far as classes. We'll have the next market update class on Tuesday, June the 20th. So have a good weekend, everyone. And we'll see you on Tuesday for the next market update. Bye now.